Hi, Shae here, editor of the Daily Reckoning Australia. Something pretty exciting happened overnight, and I just wanted to bring it to your attention and compare it to some other events going on in the market. Now, Google shares, Alphabet shares, the parent company of Google, rallied 3.9% overnight to reach an all-time high of $1,258, which is fairly impressive. Driving the price rise was the financial results that it recently reported. So it turns out the company is sitting on about $100 billion in cash and that it's still quite profitable. That's in spite of the EU fines that it copped earlier in the year. Now, that now makes one Google share worth more than 1 ounce of gold. This is not something I actually thought I'd live to see. So let's just cast our minds back to Monday. Now, on Monday, the President of the United States, Donald Trump, tweeted in almost all capital letters that he was pretty much ready to wage war on Iran. And do you know what the gold price did in response? It fell $1. And then it continued to trade down for another $5 per ounce for the rest of the day. Now, whether we should take Donald Trump's tweet seriously or not is a video for another day. But the point here is that gold is a reactive metal. Now, if we have the President of the US threatening to wage war through social media, you would expect to see the gold price spike higher at the very least, if not by $5 or $10 an ounce. At least that's how it's behaved in the past. Which is why I can't escape, I'm not being able to escape these web rumors about just how manipulated the prices of gold and silver are at the moment. And I think what we really need to start calling the gold price falls is what's called a managed sell-off. Now, of course, there's always the argument there that a gold bug will say anything to defend the gold price. And you do, when you start calling things managed sell-off and manipulation, you do wonder if you're posing into the conspiracy theories of the web. But there are persistent rumours that massive international banks are actually driving the gold and silver price lower by keeping short positions open on the futures exchange, which are far outweighing the long positions on futures exchanges around the world. A quick example of this is if you go to COMEX, the net positions or the net short positions outweigh the long positions on gold by about 22,000. The same goes for silver. You've got much more short positions, something like 8,000 contracts short versus the long silver contracts. So basically what this means is there's more sellers of gold and silver than there are of buyers. And this is why we need to start calling the gold and silver price falls that we're witnessing very much part of a managed sell-off. Now, what this means is that I am still anticipating bigger falls in the gold price. We can't escape these managed sell-offs. So basically, I do think we're going to see a couple more sharp falls in the gold price. What will happen though is because the price is being driven so low, when the gold price does suddenly spike higher, it is going to catch a lot of investors off guard. That's all from me. I'll be back later next week. See you later.